Free and clear of the chatter from Wall Street, you're listening to Talking Stocks Over Beer, hosted by hedge fund veteran and newsletter writer Mike Alkin, who helps ordinary investors level the playing field against the pros by bringing you market insights and interviews with corporate executives and institutional investors. Mike sifts through all the noise of mainstream financial media and Wall Street to help you focus on what really matters in the markets. And now, here is your host, Mike Alkin.
Welcome to the podcast. Tuesday, June 12th, 2018. Hope you had a nice weekend. Mine is in full swing now in the summer lacrosse program with my son. I don't know if you have children who play lacrosse, but it's similar to, I guess, soccer in the sense that they have a lot of tournaments. And so during the summer, it typically is up until the middle of August. It is, or late July, I should say. It's Saturday and Sunday. The travel team plays a tournament. It could be within a few miles of the house, or it could be a couple of states over. And I have always maintained that sports parents are out of their mind and they're nuts, and I will not be one of them. And while I played 3 sports growing up and I played in college, I absolutely have never put any type of pressure on my son to play. And he's, I have games on, they're in the background as a kid when he was growing up. And for a while there, he was a surfer dude, he was a skateboard dude, and he did all that stuff. And then somewhere around 8, 9 years old, just the sports thing kicked in. He's a big boy. And I mean, I'm 6 foot. And I'm not that tall, but it's 6, I guess a little bit more than average. But they project him out to be somewhere about 6'2" to 6'3", and he's lean and he's in good shape and big for his grade. And so he plays football, he plays basketball, he plays lacrosse, but football and lacrosse are his real loves, and he just has started to really kick in playing. Last few years lacrosse, he's really kind of grown and started to thrive in lacrosse. And he's a defender, and he plays defense, and that's what he did. But last year there were some goalie issues, and he wanted to. He said, "Dad, I'll be the backup goalie. I'm happy to. He starts on defense, but he said I'm happy to play goalie." And I thought, I don't know if you've ever seen a lacrosse ball or felt one or seen a shot, and the lack of equipment that they wear. And I thought, you got to be kidding me. So he wound up. Last year, he was the starting defender, and when the main goalie needed a rest, he'd play goalie, and he did okay. He was okay. There's a lot of technique you had to learn. But then the starting goalie on the travel team went to another travel team, so he said, "You know what? I really liked it. I'm going to play." And I said, "Whatever you want, buddy." And so here he is. He starts at goal, and I got to tell you, being the parent of a goalie, even though win, lose doesn't matter. Who cares as long as they have fun, right? I say that. I mean, we're pretty fortunate. Our town has a good lacrosse program. We just won the state high school championship this weekend, but a lot of the parents they get the joke. They take it for what it's worth. They don't prep their kids from 10 years old to go play in college. Many of the dads who coach happen to play at the Division I lacrosse level in the town, but it is what it is, so nobody's living vicariously through their kids. But I sat on the lacrosse field, and I watch them play, and so it's, they're all day events, and sometimes my wife and daughter will come, and for those 6 or 7 weeks, we do it, and we travel, and we have fun as a family. But my daughter's a trooper. But yesterday was really the first time where this weekend, they played a tournament, which they actually won. And he was, I got a chance to stand behind the goal during the games for whatever reason. This field accommodated that. And he's out of his mind. I mean, these 12, 13-year-olds, I mean, they're little, these kids shoot rockets. And I literally was feeling it. Now, I'm no stranger to contact sports, but this was nuts. You are standing in goal unprotected with equipment, just little shoulder pads, a chest protector, and they're shooting from 15 feet away. These kids are firing rockets, and at this age now, they're really getting up there. And my wife was thinking about walking behind. I thought, there's no way if she sees this, because from the side you can't really tell. So it as a parent sitting there, it was pretty frightening. And he got drilled a few times off the kneecap and everything, and he laughs it off. And I will absolutely say he's a much tougher kid than me, than I am. So it was that was part of my weekend. Subway Series, Mets, Yankees. None of you care, because who cares? It's the Mets and Yankees. But the Mets finally won a game after losing 9 straight. And I just actually recovered this week. My trip. So I took the red eye back from the Nuclear Fuel Buyers Conference, and that's something, I finally have realized in my life, that I'm at the age where I can't do the red eye anymore. I mean, it was my badge of honor to, throughout my career, go to a city, and I'd finish my meetings, whatever time, I'd have dinner, I'd head to the airport, take the 10, 11 o'clock flight from the West Coast, get back home, land 6 a.m., and then just get at it, go right into the office and do it. And that was just part of it. Maybe catch a couple hours of shut eye on the plane. And the theory was, I didn't want to be in the air while the markets are open. And that's just kind of what you did. And I the last few times I've done it from Vancouver or California, it's wiped me out. So this particular trip, of course, and I am a magnet for this. You can't make it up. I get on the plane, and by the way, I fly coach. I have God knows how many air miles, but I'm always happy there. I get premium economy. I mean, if I'm going way overseas, I'll get business class. But if I'm domestic, I'm premium economy. I'm totally fine. I'm happy. I'm not one of these guys going up to the counter or checking my miles and upgrading all the time. It's just I'm pretty low maintenance, and so I did this. But of course, as the baby magnet I'm at, on the red eye, of course, I have a child sitting behind me and kicking the chair and doing the whole thing, and I land at 5:30 in New York. Got in my car, drove from Kennedy Airport to my house. Said to my wife, I'm just going to grab an hour. I woke up at noon, and I finally realized, what am I doing? I'm just, it's that time where I now have to admit to myself that the body, the mind is writing checks the body can't cash. So it is now going to meeting over, stay the night, and take an early flight in the morning, because I'm not that first morning of the market. I'm not looking anyway if I'm sleeping. So these things that you learn as you get older. My this past week, I learned a little bit about my own self, that I'm not being a plain warrior anymore. And I realized that watching my son in potential peril in the goal, it gave me what my Italian heritage would call agita, heartache, heartburn, the whole weekend. So anyway, we are going to have an interesting guest here. I had last week on, I had Mark Yusko. And Mark, I met a year or so ago in Dallas, as he's a friend of a former boss of mine, who's also a good friend of mine, Reed Walker, who ran a very successful hedge fund called Walker Smith Capital for a number of years. And I met Mark down at a conference, and we had a nice conversation, and we were talking uranium at the time. But Mark is a former chief investment officer of the University of North Carolina Endowment, and he's a capital allocator. So he grew up in the business. He was the number 2 guy at Notre Dame's foundation, and number 1 at North Carolina. And then in 2004, he started his own firm called Morgan Creek. And he has had the good fortune to and foresight to allocate capital to some of the best hedge fund managers on the planet in history. And he's gotten to know them very well. And so he's seen all types of investment styles. He's seen value investing, growth investing, GARP investing, which is growth at a reasonable price. He's seen good managers and bad managers. And when you're an allocator like Mark, you're out meeting other managers. So your job is to judge who's going to be good and not. So you're judging talent, and that's not an easy thing to do. And but you get to see every different type of investment style, right? So there's equity investing, there's debt investing, there's credit investing, there's distressed investing, there's foreign investing, emerging markets. He's seen it all, and I knew that Mark was has been really focused on the cryptocurrency space, and he's partnered up with another firm and really excited about it. And if you're on Twitter, he's Mark Yusko. I'm at Footnotes First, and he talks a lot about blockchain and Bitcoin, and it's interesting because Mark is about I'm 53, Mark's 55, I think he said on the phone the other day. So he feels reinvigorated too, right? Because you're around all these young people in the cryptocurrency space, and he has the ability to look out and see this. And as he said on the podcast, to him is the most exciting investment opportunity he's ever seen. Now, conversely, I have avoided the blockchain. I have avoided Bitcoin, other than just peripherally. And you have to kind of know as an investor what your strengths and weaknesses are. And I know for me that I am not a good growth investor. I'm not a good big picture visionary. And you learn that you invest with who you are. I always say invest what makes you comfortable, right? So those big open-ended opportunities I've never been good at. And it took me a long time to not short those and understand that you can get run over. If you may not see the big vision, the big picture, or I might be skeptical of it, but it doesn't mean other people are. And so while I might not be good at owning those type of stocks, I needed to learn early in my career that just because I don't like it doesn't mean it's a good short, that you have to look at the big picture. But for me, the big picture, open-ended stuff was just never comfortable. I'm more of a buy the really ugly duckling, go to the trash pile and sift through and see if there's anything here that people have overlooked. And that's how I find my long ideas, right? So, and that's the beauty about investing. You could look anywhere and everywhere, and there's no one right way, right? So big picture, open-ended growth guys, they can make a lot of money. Buying beaten up, distressed, ugly as heck stocks, if you buy them at the right time and you understand what you're looking at, that can also present a really nice investment opportunity. So there's no one right way to invest. There's all different ways. But when it comes to the blockchain, it comes to Bitcoin, I've paid enough attention just to kind of get a sense for what it is. But I just know myself, and I know that in the early stages of an asset class, I'm likely not going to see the vision, or if I do, I'm going to come up with 20 reasons why it can't work. And it's just the nature of who I am. So, and I'm not an old fuddy-duddy stuck in my ways, but I'm comfortable with my investment style, right? I know what I like to short, and on the long side, I know what I like to look at. For those of you who followed my work on uranium, right? It's a 7-year bear market, and it's beaten up, and everyone hates it. For me, when I really started focusing on it a few years ago, that was exciting, right? That to me, I wanted to see if there was value there. But so Mark and I talked, and we talked about blockchain, we talked about Bitcoin, and really he enthused me. Now, not enthused me to the point where I was going to say, okay, I'm going to focus on this, because that's not what I do, right? But where I wanted to get smarter and to be able to have a conversation. And I thought, Mark reminds me of my friend, Barry Cohen. And Barry and I were partners at a firm called Not Partners for a number of years, a good-sized hedge fund. And Barry spent his entire career in the financial technology and financial banking space, covered banks, insurance companies, asset managers, and fintech, it's called, financial technology. And Barry took off, I guess, retired from the hedge fund business a couple of years ago. And really, he and I are very close friends, and we talked a lot, and he was really excited about blockchain and all that technology. And Barry's my age, a year or two younger. And I thought, after talking to Mark, I said, I'm going to get Barry on, and we're going we're going to have a conversation that's essentially, I'm coming at it just like people who may be listening to the podcast is, I know nothing, get me smart, because it seems like a very important asset class. So without further ado, I'm going to bring on Barry, and we're going to talk cryptocurrencies. Barry Cohen, welcome to the podcast.
Mike, thanks for having me on again. I really appreciate it.
You bet. It's funny. I had you on not too long ago, but I said, I got to get you back because I had Mark Yusko on last week. I was out in Monterey at the Nuclear Fuel Buyers Conference, and I was sitting in my hotel room, and I had a call with Mark, and it was great. We talked about a lot of stuff, reminiscing about the growth of hedge funds. And, he's about our age, and we all grew up in the hedge fund industry at the same time. And Mark is really very, very active in the crypto space. And it got me thinking that, and you know me, I'm a curmudgeonly deep value skeptic and a contrarian, and not crypto, blockchain, Bitcoin, all that stuff, not my strength. But I keep seeing some really, really smart people just keep wanting to learn more about it. And I said, after speaking to Mark, I've got to get Barry on, because there is a lot of talk. Everyone knows Bitcoin, and people may know Ethereum, but it's as you and I have talked over the last year, and during our normal conversations as friends, at what's going on, you tell me what's going on. There's a lot going on in the space, and I realized I know very little of it. And I thought, there's so much noise and buzz about cryptos that maybe we should really just dig in here, and I should get smart. And I thought, if I'm going to try and get smart on it, why not let the listeners get smart with me, right along with me? So we're going to talk cryptos, but before we do, why don't you tell our listeners, tell them your background. Where'd you come from? How'd you get here?
Okay, well, I have to give a shout out to my mom. She started it all. But I started. My rise through Wall Street was not directly into investment banking or asset management. I actually, believe it or not, started off in the back office. In the plumbing, if you will. Worked my way up. Actually, worked my way through the back office into sales. Believe it or not. And my sales manager, I can remember him, super nice guy, really, really great guy. He asked me to come into his office one day, and he told me that I was too smart to be in sales, and that I should think about alternatives. Now, he wasn't firing me; he liked me, and I was doing a fine job. I think he actually gave me some of the soundest advice that anybody up until that moment had given me, which is there's a place in the universe for all of us. It's you've just got to find it. And so I took his advice, actually, and I applied myself, and ultimately I ended up working for a very well-known mutual fund complex, and slowly worked my way up through the ranks. Ultimately, to be in the hedge fund community, which exposed me to all sorts of interesting things, including private transactions and the global markets, and going long and short. And during that time, I've covered technology, some healthcare. The bulk of my career has been, as some of your listeners may know, covering the global financial services space. And the global financial services space, in a nutshell, is the word global, I think, stands on its own, but banks and brokers and insurance companies and asset managers and what's known as specialty lenders, so people who specialize in lending, let's say, for mortgages or credit cards and things like that. And then financial technology, or what's known euphemistically as fintech, as well. And when I first started, it was a very small group, but now the number of companies that are out there that fall into that category are much larger. And so, in 30 seconds, that's where I've come from and where I've found myself here.
And talk about the type of firms that you worked at, and it just, the difference. You started at a mutual fund, and then you morphed over into the hedge fund industry. Talk about that transition and your evolution there.
So I really started off on my first major Wall Street firm working for Fred Alger, which was already by that time a fairly storied, growth-oriented mutual fund company. It's still around, but that's where I first got my chops in technology and financial services, and I kind of caught the bug. So then I transitioned to the hedge fund community, and a lot of people like to imagine how glamorous it is, but it's a 24-hour day job, 7 days a week. There's a lot of risk that you take in your career working in a hedge fund versus a mutual fund. So you really, what you find out is the people who love working in that environment are people who just love being able to invest. And really,
Barry, explain for listeners. You say there's more risk being a hedge fund person than a mutual fund. Why is that?
Well, the model isn't really stable, right? I mean, first of all, everybody assumes that if you're working at a hedge fund, it's like this $10 billion, $20 billion Goliath. But the truth of the matter is, the large chunk of the industry is probably got less than $1 billion under management. And so it doesn't really take all that much in terms of having one bad year, which can happen to anybody, to find yourself having a lot of what's known as redemptions. And redemptions is a fancy word that the industry uses for when your customers take their money away from you. On top of it, you're really competing. It's a very, very difficult business. So let me set up a simple explanation as to why it's a really super difficult business. If you're a hedge fund, you are telling your customers that you're going to do two things for them, that you're going to lower the risk that they're assuming with their investments, and at the same time, you're going to earn them a very high rate of return. Now, on the face of it, right off the bat, that's an extraordinarily difficult proposition. So let's take what a typical hedge fund looks like. In a typical hedge fund, forget the math of how you get there. A typical hedge fund will have about, let's say, 40 in equities, will have about 40% exposure to the market, which means that if you invested, let's say, in the S&P 500 index fund and you put $1,000 in, your exposure to the S&P 500 is 100%. You own $1,000 of the S&P 500 index. Okay,
Mm-hmm.
A hedge fund would probably only have $400 out of that $1,000 example exposed directly to the market. And the way they do that is through either holding cash or having shorts on the other side of their investments. Mm-hmm. And so it's a very, 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 very difficult business. And Mike, you're one of the best short sellers I know in the market. You're incredibly good at it, both in terms of the art and the science. And I don't think anybody that I know would say that short selling is a good business. And we can get into all the nuances about shorting and how you do it and the mechanics of it, but I'm just going to make it really simple. Let's take two investments. Let's say you're long IBM, or let's say, and another person short IBM at the same day, $100 a share. The guy who's long IBM, he can hold that stock forever, and he can compound, right? And he can compound year after year after year after year. And theoretically, there's no cap to how mm-hmm. much money he can make or she can make, right? They own that stock for a decade, and IBM's earnings grow 20% a year, and Wall Street rewards it with an astronomical multiple. They could make 1,000%, 2,000%, 5,000%, whatever the number is. That's the power of compounding. If you're short that stock, forget that you're wrong in the first portion of my example. Okay, forget that you're wrong. Let's say that you are right. Let's say somebody finds out every product that IBM ever made is fatally flawed, and the stock goes from $100 to zero. And let's say that it happens overnight. The most you can make is 100%.
Yep.
That's the most you can make. On your best day, you can only hope for 100% rate of return. So when you look at those two styles of investing, okay, which one do you think over time is easier and will give you the higher rates of return? I know which one I would choose. I'm pretty sure your listeners after this example would probably choose the same one. So hedge
So then
funds.
that begs the question. So then why do hedge funds exist? Why do people put money in them? And I would argue, it takes a 2008 year of down 39% or 40% in the market, and people need to then make up, be up over 60% to make up their losses when the hedge funds dramatically outperform. So what role do hedge funds serve?
Well, okay, so I mean, you basically talked about one of them there, right? So you might think about that as the parachute model. That when the world ends, you're invested in things that will protect you, and even theoretically can make money when the world ends, right? If you're long,
Yep.
The S&P 500, it's some low cost ETF, unless you are willing to sell and time it perfectly or somewhat perfectly, you're just along for the ride. That's the flip side to the compounding beast, right? Like you get all the virtues of the compounding, but on the other side of the coin, in order to do that, you're in it to win it.
Yep.
Right. So you did speak about like what you might describe as like your parachute, right? When you get like bear markets, the hedge funds, that's when you really see the value. I would argue there's something else though. So for example, let's take an imaginary hedge fund that was down that year 25%. Okay. In order for all of the partners or managers and portfolio managers that may be at that fund to get paid, they have to earn back every single dollar that they lost that year. And then they have to make money on top of that in order to actually get paid. So if you're a mutual fund manager, okay, and you're down 25% because the market's down or whatever it is, you're still getting paid. Now, maybe you're not getting paid as much, but you're still getting paid. So a lot of people forget just how tied hedge fund managers' incentive compensation is to the performance for their customers.
And when you say paid, there's two ways a hedge fund manager gets paid. Even in an up or a down year, the hedge fund manager is getting their management fee, which could be 1.5% or something. It used to be 1 forever, and then it went up to 2, and now fee compression has brought it down. But let's say 1.25%, 1.5%. But when you're saying paid, it's the incentive it's the incentive compensation, which is a portion of the profits that are made, and that's where most hedge fund managers and hedge funds will make the bulk of their is called performance fees. That's where they'll make the bulk of their income. So what you're saying is if they're down, that performance fee doesn't get made up. So using your example earlier, you're taking 40% of the market risk in that one example, but you got 70% of the return. Hedge fund investors who invest in hedge funds understand that they're paying an incentive performance fee, and so that performance fee, which is what the hedge funds are in the business for, goes away when they're down, and they have to make up those losses.
Yeah, that's 100% right. And again, I would say to you that a large chunk of the industry isn't, $10 billion hedge fund. And so,
yeah, that's right.
A lot of parts of the industry, that annual 1% is the, it more or less turns on the lights, right?
Yep.
Like for some of the larger funds, it might be a cushion or even a profit center, but for the large chunk of the industry, that's how they turn on their computers and pay their secretaries and their rent and, eat.
Yep.
So, and I don't want listeners to think that like I'm out here, kind of, proselytizing for the hedge fund community. Like I'm not here to sing their praises, but I also think that oftentimes people, don't realize just how difficult the business is. See that there's a lot of people in it who are in it because they just love what they do. They get a lot of professional pride and even excitement out of being able to figure out how to make money by both shorting stocks as well as going long them. And that there are balancing points within the industry itself that, help to align or incentivize managers with their customers, which isn't really the truth in a great deal of other portions of the asset management business.
Yeah. So, all right. So now you're you spend a career looking at financial technology and global financial services. And I remember when we would sit down, we were partners for a number of years, one of 5 or 6 partners at the firm. And when we would talk fintech, financial technology, I think it's pretty funny because I would glaze over. It was complicated. And we would talk about payment processors, and you and I would sit in each other's office. You'd ask me what I was looking at. I'd ask you, and it was complicated stuff. And you know me, I am a deep value guy. I am not a growth guy. I'm not a visionary. And you have the ability to look at bigger picture stuff. And so now the last couple of years, I know that when you retired from the hedge fund industry, you were sitting down in Florida and enjoying a little bit of time and really started to pay attention to the blockchain, to cryptocurrencies. And Mark was saying on the phone last week, Mark Yusko, it's the most exciting investment opportunity he's ever seen. And so I have talked to you on and off about it, and I listen. Sometimes I half listen because it starts to get a little complicated for me. But I'm devoting myself to this next 45 minutes to really getting smart. But if I were to summarize what I know so far is, and tell me if I'm wrong, but the investors know about Bitcoin. They may know about Ethereum and maybe one or two others. But basically, and people originally think that this is, the debate becomes, is it a store of value? Will it replace fiat currencies, it being Bitcoin? But underlying this technology, Bitcoin, this digital currency, is a technology called blockchain, which is a distributed network. And it's no one central authority. And people kind of like that because there's no big brother. But this whole blockchain technology evolution creates endless possibilities. And I'm going to have you talk about that in a minute. But it's also created a lot of excitement, investor excitement, and the structure in which these can raise money has created a land rush, a land grab for people trying to get into the business and trying to raise money. And normally, as you and I know it traditionally, that's called venture capital. And venture capital is open to accredited investors only. They have to meet certain criteria. And there are venture capital funds, and it's hard to find them and get into them for ordinary investors, for retail investors, to get in on the early stages of stuff. So now that the Bitcoin and all these other cryptocurrencies, I think there's 1,600 of them, have come along, people get excited because it's a way for them to get access to new early stuff. Well, one of the things that I know from being a professional investor, knowing venture capital is wildly risky. Most of it doesn't work, and the ones that do work are the 100 baggers, and it makes up for all the others. But it's the Wild West a little bit, if you will. But you have professional funds being run, only accredited investors who are sophisticated investors could get involved. But now you have the ability to raise money pretty easily. And there's been a ton of money raised, which unfortunately, you and I both know, is when there's easy money to be had, bad actors enter the space. So I want to first touch upon exactly what this whole phenomenon is with blockchain, and then let's talk about the risks associated with it. But explain to me the genesis of your interest in it, why you got interested. Financial technology. What drove all this?
Wow, you always ask great questions.
By the way, that is the first time I've ever spoken more than you in our lives. I was timing it, and I was hoping you'd go a little further. Yeah, normally I'm cutting you off, but I got a little
that's
long-winded.
Okay,
but
I love it. I love it.
Yeah.
So, I listen to your podcasts assiduously, and of course, Mark Yusko is storied, and I listened to what he had to say, and you and I have talked about this offline a lot, and I would say that I agree with everything that he had to say about it. So having actually gone through
I don't know, like 3 bear markets, the internet coming onto the scene. Well, frankly, actually, the personal computer coming onto the scene, the internet coming onto the scene, the personal computer bubble bursting, the internet bubble busting, and then the internet coming back. This particular evolution, some might even argue revolution,
Yep.
I believe has all the possibilities of being the most interesting thing that I've ever seen in 25 years of investing. Like, I don't think anything kind of comes close, because, you know, if you're an internet company, right, and you're going to sell books, and you do a bang up job doing it, and then you become like a global retailer that, you know, basically is an industrial sized warehouse. And you trade at, you know, $1 trillion, and the guy who owns you is worth 90 billion or something like that. And that's an amazing story, and they don't come across all the time. But it doesn't have like a lot of things in it that the blockchain does. You know, so for example, I mean, if you kind of think about it, the key components for what made Amazon work, nobody ever pays for, right? So like when you log on to the internet and you look at that little HTTPS thing, like nobody makes any money from that, but without it, like, it just wouldn't work, right? You know, nobody pays for DNS, you know, at least outwardly. Right. So all of those backbone pieces of software that make Amazon what Amazon is, in the wider sense of the word, there's no economics there, or little economics there. Whereas when you think about blockchain, it kind of turns it all on its head in a way, right? So like all the things that make it work, right? So like whether it's Bitcoin or Ethereum or Stellar or Zcash or any of them, that are really kind of more like what's known as protocols. And for listeners who aren't familiar with the word protocol, the easiest way to kind of internalize what that word means is, think of it the way you would think like an operating system. So if you have an Apple, you'd have the Apple operating system. If it was Microsoft, you'd have the Microsoft OS operating system. And it's the underlying technology, or in that particular case, software, that lets everything else that you have on your computer run, right? So if you have a PC and you're running Microsoft and you're running Microsoft's operating system, that's on top of that is where your word processor relies. On top of that, that's where your email resides. On top of that, that's where your web browsing, whether it's Google or something else, resides on top of it. And that's the way it works. And right. So in blockchain world, the operating systems are like Ethereum or Bitcoin or any of those. Those are what's known as protocols. And all the other ones that you hear about, okay, you know, and I don't know how familiar any of your listeners are with any of them. I'll just, you know, name, you know, one or two, like, you know, whether it's Filecoin or Funfair or, you know, any ones along those lines. Those are what's known as applications. And applications in blockchain is very similar to what I just described with your word processor. Your word processor is an application that sits on your Microsoft. And these sit on, you know, Ethereum or IPFS or Stella or any of the other ones that are out there. And each one is carving out economics in a very, very, very different and profoundly sometimes different way. And I find that just right off the bat, like very, very exciting. So the technology is incredibly exciting, and it's constantly evolving. Like when people talk about Bitcoin, my guess is a lot of listeners, not all of them, but a lot of listeners are just like, yeah, it's Bitcoin. It's out there. You know, it came out like a decade ago, and it's Bitcoin, right? And they sit around the bar and they'll say, yeah, you know, the reason why it's going to be worth a ton of money is there's only 21 million of these things, and everybody's going to want to own one, and because there's only a limited amount, like the price is going to go up, which is fine. It's a very simple way of thinking about it. But what they don't realize is that every single day, of every single week, of every single month, there's a bunch of developers that are working on improving the overall functionality of Bitcoin. Like it's not a finished product. Ethereum is not a finished product. It will go through iteration after change, after development, failure, fix, patch, iteration and on and on and on. And this will keep on going on for a long time. And who 10 years from now, is at the on top of the leaderboard? I'm not necessarily saying number one, but let's say top 10 may be very different, frankly, than who is on top of the leaderboard today. Like I'm willing to bet, like if I could speak to this about like the financial services industry, if you went back 20 years ago and you looked at the largest banks, some of the largest brokers, some of the largest insurance companies out there, okay, a lot of those companies, they don't even exist anymore.
Yeah.
And if that's true in financial services, which tends not to get blown out of the water all that easily, right? Because they're regulated and they have real capital and customers. Sometimes they disappear because of mergers. Think about what it's like in technology. I mean, if you go back far enough and you kind of like think through it all, I mean, does anybody ever use the word Wang computer anymore?
No.
Or Sun Microservice?
Digital.
No, they don't. In fact, I'm willing to bet, depending upon the demographic of your listener base, some of those people have no idea that those companies ever even existed.
Right. Yep.
And when the PC revolution started, there were hundreds of manufacturers of PC. Like, there's not hundreds of manufacturers of PCs anymore. I mean, even if they are, they don't matter, right? Like they're like so small, like nobody even notices they exist. There's a handful. And the same thing for printers. And the same thing happened with copy machines. I mean, think about Xerox. Xerox was the brand name in copying for how long? Even to this day, people might even say, I'm going to make a Xerox, but they're doing it on a Toshiba machine. Right? So what people assume is going to happen today, I can guarantee you 10 years from now, we'll look back and a chunk of that will not be true. Right. And so I find that fascinating. And I find it invigorating, and I find it stimulating. And
what makes the blockchain revolutionary? What makes it bigger than the internet? What is it about it?
Well, I mean, it takes a chunk of what the internet is, which is really basically a global communication network, and layers on top of that the ability to have a record of transactions that nobody can change. It's what they call immutable, right? So immutable is like a fancy word for saying, like, once it's on there, it's always on there, right? And you can't go back and kind of undo it, right? So you have this continuous block or chain of blocks of all these transactions, and you can go back. And then a listener might be like, well, that sounds great, and I'm sure it's fascinating, but what does that do with me? And I'm like, okay, well, let me give you an example about this. Let's say you buy a home and you have title to it, and generations pass and people don't know where it is and things get lost in the history of time. If your title for your property, I don't care if it's your home or just land you own somewhere that nobody knew you owned, if that's on the blockchain, like nobody can take that from you or your heirs and down the line. And while that might not seem like a particular major issue, let's say in the United States, there are lots and lots of countries around the world, and I do mean a lot, where property ownership is squishy. Like, you'd be surprised, like how many people in countries, they will have multi-generations living in a house or a connection to a house that's sitting on a plot of land that actually belongs to someone else. But their grandfather worked the land for the guy who owned the land, and he gave them the right to build a home for his family. Now, they don't own the land, but they think they do. 3 generations down the line, they think that's their house. Now, and maybe the guy who owns the land or his future generations will say, I'm going to give you that land, but legally they don't. And so you can't begin to imagine how big of a deal that is. Or even take in our highly evolved economy, the idea of intellectual property. It is not easy to actually ensure that your intellectual property is put together the right way, is stored the right way, is cataloged the right way. It is even harder if you're doing a search on intellectual property, whether you're doing mergers and acquisitions, so you want to know the provenance of what you're buying, or you do a development and you want to make sure you're not stepping on someone else's toes, because the last thing you want to do is come out with a product and some guy you never met before sues you for $500 million because it turns out you're using something that belongs to him. You can't begin to imagine how hard that is to do, even in the United States. And what makes it even worse is anybody could basically sue to attach themselves to IP. And then you've got to go through this entire long process of proving your provenance to something you own. The blockchain will help solve that. So, I know those are a little like, that's not like I own Bitcoin and I think it's going to, 50,000 kind of comments. But from a practical perspective, those are two very real life things that this is capable of doing. And just try and imagine what it could do in healthcare. Try to imagine what it could do in banking. Try and imagine what it could do in inventory management or food safety, assuring that what goes from the dirt to your dinner table is known, right? Just imagine what's capable. And the more you imagine, the more you realize what it can do.
All right, so get me smarter on this. And this is where I struggle. I'm so confused by it all. So if a couple of years ago, when you started talking about blockchain and Bitcoin to me, I was like, yeah. And it's been around by Bitcoin since '08. But as you've got these legions of people who are libertarians, some anarchists who believe that blockchain or Bitcoin is going to displace money as we know it. Everything will be, no one will have cash anymore. And so there's kind of like this, there are these different camps. There's this, it's a store of value. It's like gold. But then you have this whole evolution of, well, it could change the world. And to somebody listening, I mean, how do you think about this? Because do you buy Bitcoin or Ethereum or anything else, or because they are going to be stores of value, or because the underlying technology has uses that can change the world? How does one think about that?
Well, the simple answer is yes to all of them, in the sense that it's possible that some of these cryptocurrencies are capable of doing more than one thing at the same time. Mm-hmm. So, whereas others are not capable of doing more than one thing, many of them aren't even capable of doing what they say they're going to do. And so it really, I hate to say it really depends, but it kind of really depends. So let's take Bitcoin for a second. If somebody, and this is what I'll say to anybody, I'll say it on the phone with you, I'll say it at a bar, I'll say it on the stage, I'll say it to anybody. If enough people believe that something has value, then that thing has value. And then it's just a question of price at that point. Like I believe value is at $100. I believe that value is at $1,000. I believe value is at $10,000. But if enough people believe it, then it's so. I mean, at some point there were lots of people who believed seashells had value, or wampum, or tulips. But tulips is a bad example because then everybody goes into the whole tulip mania thing, cryptocurrencies, which I just
when you said that, I said you just walk yourself into a bubble.
I know, I walked myself into the buzzsaw, and I'm going to walk myself out by saying right off the bat, I don't subscribe to that view. I'm just going to let you know, I don't buy into it, and I would be happy to argue anybody about it. Right, the prices might be too high at any point, might go lower than they should. That's different than tulips. Okay, tulips were a commodity that die several days after they are born. They inherently, the only value they have is aesthetic, and it's a whole group of people believe that there was something else to them. That's their problem. Okay, this is computational power supported by electricity. Those are two what I would say known quantities that have tangible value, and once you ascribe a monetary value to what is essentially is a unit of measure, gold, for example, it has value. So will Bitcoin be a store of value? Yeah, I think that there's enough evidence to suggest that. When you start talking about a payment vehicle, you bring up a couple of there's a couple of underlying important issues which ultimately need to get resolved in one way or another. One is what's known as scaling, the other one is cost, and the third is volatility. So let's tackle them in that order, because they're relative. The first two are relatively easy. I'll actually talk about cost first. Cost is pretty straightforward. How much does it cost you to transact? Now, when you go to Starbucks and you take your credit card out, you don't even see that as a consumer, right? That's 2.5% that they charge Visa or MasterCard, or more to the point that Visa and MasterCard charges Starbucks. You're not theoretically paying that out of your pocket. Like, so if you bought $10 worth of coffee at Starbucks, you don't get, and you take out your Visa or MasterCard or American Express, they don't go, oh, I'm going to put a 2.5% tax on top of that to pay for using it. In fact, actually in the United States, it's illegal to do that. And so you as a consumer, you don't see that, but it's there. And just like that, there's transaction costs involved in using cryptocurrencies. Mining is an expensive business, and they want to get paid, and they get paid in a variety of ways. But there's other inherent costs in the system too, like if you're on an exchange.
Barry, explain mining for listeners who may not be familiar with it.
Yeah, the 30-second view on mining is that think about rooms filled with computers that are solving complex mathematical equations in order to ensure that the transactions that are going over the network are valid. And once somebody validates those transactions, they essentially win a prize. And the prize in this particular case, we're talking about Bitcoin, is getting paid right now 12.5 Bitcoins every time they put a block up. And the block will have a certain number of transactions in it, depending upon what those transactions are. So mining is basically using computers and a lot of electricity to solve mathematical problems, and then to store all that data once those transactions go up on the chain. And that's what mining is.
So miners mine Bitcoin.
Miners mine Bitcoin.
They solve it to validate it, and they get their payment in Bitcoin.
That's correct.
Now it's a lot of electricity, an enormous amount of electricity to drive these powerful computers. Is there a price that a Bitcoin miner looks at to where it's the cost of providing or solving the equation is profitable for them? Is there a Bitcoin price that they think about? What is the break even for them?
Yeah, I mean, so there's no real industry standard in the sense that it's not like so if you make I'm trying to think about it. If you need to buy steel to make something, there's a very open public market for what a ton of steel costs, right? I mean,
Yep.
You know this, right? Like you could go onto your computer and anybody could find within seconds a pretty reasonable facsimile of what a ton of steel would cost today. And you can look back at what it cost a year ago or 10 years ago, and you could do that.
Yep.
A lot of what goes into mining Bitcoin, that's not necessarily true. Like, so it's true about what it costs you to buy some of the equipment, right? Because there's basically two manufacturers that constitute something that looks like 90% of market share of these what's known as mining rigs, which is really basically a chip, a specialized chip housed inside of a unit that has other processing power and capacity, as well as like cooling capacity and electrical capacity. So it's kind of like it's a very small, highly specialized computer. You just want to think about that, like a desktop computer. But
who are those two?
The big one is Bitmain. It's got like 70% share, and I forgot the other Chinese manufacturer. I didn't have enough coffee this morning. I apologize, but between the two of them, they have like something that constitutes about 90% share. And then there's a number of other manufacturers below them, almost all of which are in China. There is some discussion about some of the large U.S. chip manufacturers like Intel or AMD that might get into this, but we haven't really seen anything publicly brought out in the marketplace yet. So those costs are fairly knowable, right? Like you have a pretty good idea of what those market costs are. But the biggest cost on an operating basis is electricity. And frankly, the cost of electricity can vary a great deal. I mean, if you're sitting in, Kansas and you try and mine one of these things, like the cost of your electricity could be 2 times the amount of what it costs somebody sitting in Vancouver using hydroelectric. And so where people's break even is very dependent upon one, the types of machines they're using to mine, right? Because machines that have more computational power can figure out the equations faster, right? They're just pushing harder and harder against the equations. And then also what it costs you for electricity. And so there's no real standard.
Okay.
I know a couple of miners whose break-even costs are between, $1,300 to $2,000 per coin. So if Bitcoin gets below that, they are not making any more money. Now, there are things that they could do, right? There's things that they could do to kind of, maybe manage their business. But I know two that are at that point. So we don't really know. We don't really know what happens. My guess is that some of this stuff gets turned off because it's just too expensive on the margin. It's like any other mining operation. Just think about like all the conversations you've had about uranium. At some point, producers realize that they can't lose, $30 a pound, a ton, right? Every time they pull rock out of the ground. And the same thing could be said for Bitcoin. There's no point keeping your machine on if you're losing $500 every time you try and do it, right? Like it's just not economical, right? So that's mining.
Okay. So you have mining, so people producing it.
Right. So let's get back to like store of value and all the rest of this stuff that we talked to. Like we kind of got deep into the weeds, which I don't mind, but I want to bring us back to like the original question. So the first one can be a store of value. The simple answer is yes, definitely so. And scaling. So it's scaling, cost, and volatility. So scaling is the process by which a network, how fast a network can process transactions, right? So if you just think about it, if you had two networks and one network could process, 100 transactions every second, and yet another network doing the same type of transactions that can process it at like 2,000 transactions a second, which one of those networks are better? So when people think about this as a payments vehicle, one of the things that you have to consider, we talked about cost already. The other is, which is improving. The other is scalability. How quickly can the network actually process transactions? And oftentimes, a number of the benchmarks that are used are more traditional payment methods like Visa or MasterCard or American Express, because those networks are well established. And therefore, if you want to become an alternative or even supplant the current embedded networks as a payment vehicle, you're going to have to be able to function at least as good as they do. Mm-hmm. Right? Like you're never going to really reach for that brass ring if the best you can do is 1/10 their speed. It's just not going to work. So there's a number of different developments. Remember, I talked earlier about how people should think about these things as just ongoing software projects. There's a lot of development taking place around improving, kind of like this functionality, if you will. And with Bitcoin, you have something called the Lightning Network. And the Lightning Network is what's known as a side chain. And so basically it sits, if you want to visualize it, sits below the Bitcoin blockchain. And all the transactions kind of take place at that layer of the network. And therefore it's a lot faster and then once you've aggregated and you want to put it on the network, then you go through the full process of effectively validation and block origination and storage. Now I've clearly minimized what's taking place in the Lightning Network, but talking about that could take a really long time, and we can go much further into the weeds. But simplistically, my point is that whether it's Ethereum, whether it's Bitcoin, whether it's Bitcoin Cash, whether it's Litecoin, whether it's any of these blockchain currencies out there that are striving to be a payments mechanism. All of them, in one way or another, are thinking through and trying to figure out technological solutions to increase that scalability. And then the third thing, which frankly, none of these protocols, none of these projects really can do anything about. I mean, some people think they can, and I think it's misguided, is market volatility. And why is this a problem? Okay, you and I, Mike, we've had this discussion several times, but for listeners who may have not thought through this, today, Bitcoin is down, I don't know, someplace around 10%. So if you wanted to buy a cup of coffee yesterday at $1, $2 worth of coffee yesterday, it would have cost you a certain percentage of a Bitcoin. Well, today, you would have had to pay 10% more in terms of the number of pieces of Bitcoin that you paid for the same $2. Now, normally when somebody reaches into their wallet and takes out, either cash, what's known as fiat, or their credit card, $2 is $2 is $2 every day of the week. It's every day of the week, every month, every year. It's just $2, right? The only places in the planet where that's not true are hyperinflationary countries like Zimbabwe or Venezuela now, where prices go up, astronomically from day to day, right?
Yeah.
In this particular, and look at what happens inside those economies. Those economies become non-functional, right? And they're non-functional because you can't have that kind of disturbance inside of a currency unit, right? It doesn't allow for normal commerce to take place.
Yeah.
Right? And so one of the problems that exists inside of the crypto space at the moment is the inherent volatility of the currencies. Now, there's a lot of reasons for that, right? Like there's no this is the reason, and therefore if you know what that reason is, therefore you can solve it, right? It doesn't work that way. There's lots and lots of reasons for it to happen. Not the least of which is, if you want to think about it, that these currency units, if you want to call them currency units, they're really tiny in the scheme of like how many US dollars are out there, or how many euro out there. And so the ability for volatility to exist inside of a tiny market is really high, right? Like, so it's like the laws of larger numbers in a way, right? So over time, at least in theory, over time, as the outstanding value of a Bitcoin or a Litecoin or Bitcoin Cash or any others that wish to be Zcash or any that wish to be payments vehicles, as they get bigger in market cap, if you want to think about it that way, there should be some dampening of the inherent volatility in them. Now, part of the volatility, of course, is based also on other things, which is it's a very nascent market, and you don't really necessarily know who owns what and why they sell it and how fast they sell it and where they come from. You don't have the news flow that's in the marketplace. Some of it can be very legitimate and very helpful, but some of it, quite frankly, is just garbage, right? And people also still struggle with, well, how do we value these things and what underlies them and stuff like that. And then you have governmental regulations, and one regulator in this area is one way, another regulator is another way. I mean, even inside the United States, when you take a look at like the verbiage that the head of the CFTC, which it regulates derivatives in the United States, versus the SEC, the CFTC language tends to be more pro-cryptocurrency. They tend to say this is a phenomenal technological change. It's a generational change. We really should embrace it. We really should move forward, blah, 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 blah. The SEC, on the other hand, tends to take a more strident view, if I could say, on the subject matter. They, say things like all of these are securities, or most of them are securities, which of course sends shivers down the spines of an awful lot of people, because the last thing that you really want to do is have issued an illegal security. That's a problem, right?
Yep.
It's the kind of problem, and you and I have joked about it, that's the kind of problem where people say orange is the new black, right?
Yep.
Just like money transmission. Like if you transmit money illegally, without a license, that is, that's a real problem. So, it tends to send shivers down the spine. And then you get like news today. There was a little news that a relatively small Korean exchange was hacked, and the news items are suggesting that $40 million of currency were stolen. Those things don't lend themselves to a sense of security, right? And since this is, for all intents and purposes, a industry which is striving to provide, for lack of a better way of saying this, financial security to people in a way that they don't have to rely on centralized bodies like banks or governments.
Yep.
When somebody can basically hack into the system and steal $40 million, it does undermine a little bit, the very nature of what the industry is, one of the things the industry is attempting to do. Now, this is not the first time it's happened, and it certainly won't be the last. But
is
again,
there like is there an SIPC for people? Are they protected if where they're holding their money is hacked into?
The answer to that question is basically no. So there are a few exchanges. There's one, maybe two exchanges in the United States where cash at the exchange is segregated and has protective fraudulent insurance on it. But the actual cryptocurrencies themselves, the answer is no.
Okay, so now we have 08 Bitcoin comes. It's now at wherever it is, 6,500, 6,700, something like that. It's been as high as 19,000. It's still been a moonshot from just a year and a half or so
ago. I think it was like almost 8,500, right?
So so we've got volatility like you were talking about,
right?
But now we've seen this evolution. Now all of a sudden we see all of these initial coin offerings, and I lost count. Last time you told me maybe there are 1,600 of them. So, and this is what our listeners who are ordinary investors, might be the stuff that they start to get interested in. Could you explain what an ICO is, the evolution of ICO, the different types of coins that are out there, and what people are getting for this, and how easy is it to raise money? Because it appears to me to be very easy. And when something's very easy to raise capital, you're going to have a lot of fraudsters coming to the space. So walk through people what an ICO is, what's out there, what they need. I mean, how do they think about protecting themselves?
Right. Wow. Well, also always great questions. I keep on
because it always seems to me, if venture capital is the Wild West, this is like the frontier of the Wild West, unless I'm mistaken.
Yeah, I mean, so one of the things that venture capital does, there's a number of things that venture capital has a propensity to do really well, and that is because they're fiduciaries and because they get paid on performance, they really have it in their best interest to act as a gatekeeper, if you will, right? Like, they're not in business to say yes to all comers, right? That doesn't mean they don't make mistakes. It just means that they're not in the business to say yes to all comers, right? And the due diligence process, as a general rule of thumb, within professional venture capital and private equity, tends to be reasonably arduous, right? And for certain types of projects, I mean, they may start doing vetting of your code, right? And they're certainly going to ask questions like, well, who are these people and where do they come from, and what kind of, do they have reasonable experience set? Like, what does your business model look like? Are you ever going to make money?
Yeah.
Basic good old fashioned business questions, which, I mean, some people that invest in ICOs ask, but other people just, if I've been on enough chat rooms, Mike, to see how people react to things, to tell you that, there's a lot of people who take what could be described as investment advice basically by people saying, oh, this is going to be a hot deal, right? But they may not even know what it is that they're buying, but all they're getting is like the social media buzz, and the buzz is really high, so therefore I got to own something, right?
Yep.
And I think it's that gatekeeper issue that really is the difference between kind of like the professional markets, whether you want to think about that as the IPO market, the initial public offering, which is for traditional stocks, venture capital and private equity, and the ICO market. The other thing that's different is that venture capital and private equity tend to be what's known as milestone investing. And milestone investing is really actually quite a simple concept, which is You go to a venture capital or private equity firm and you say, here's our idea. And they say, okay, we like this idea. We want to invest in you. What are the stages of development? And, I'm not going to get into trying to create an imaginary set of stages of development, but let's say that there are 3 key stages of development to get your product from concept or beta into something that looks like it's actually in the real world. Okay?
Right. Yep.
Now, they will give you some portion of the money that they think that they're going to have to give you in order for you to get from point A to point B. Now, if you get to point B, in a reasonable, kind of inside the reasonable time frame that you've given, obviously, there again, art and science, right?
Yep.
And people could see that you've successfully reached what was essentially an agreed upon point B. They will then give you another round, and then to point C, and so on, and blah 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 blah. That's what's known as milestone investing, and what it's designed to do is probably pretty obvious, which is that if we gave you $50 million day one, that doesn't necessarily align everybody's interests the same way. Right? And it might turn out that you didn't need $50 million, right? Maybe you only needed $25 million to get you from point A to point C, right?
Yep.
Or maybe you even needed more, and you're not going to know that until you're kind of in the process. Now, ICOs, there's milestones in the sense that legitimate ICOs will put out a roadmap, if you will, to what is it that they intend to accomplish, and over something that looks like a time frame that people can kind of keep tabs of that. Now, many of them don't really make a lot of announcements along the way, which is another subject matter. Communication is another subject matter, but I don't want to get too far afoot. But what really separates ICOs from, let's say, traditional VC and PE is that you go out and you raise the money, and it's a kind of all or nothing thing, right? Like you either raise a certain amount of money and you're up and running and you're viable and you have enough cash in your hands, or you don't. And it's very different. It's just a different financing mechanism in that respect. The other is of course, your rights as an investor are different. Many of these things aren't really equity. You don't really own equity. You own what's known as a utility, right? And we can talk about that in a second because ICOs kind of delve into the different types of coins. So we'll get there in a second. And so you don't really own an underlying ownership of any kind. Forget partial. Forget anything. Zero. You own utility, and the biggest utility that's commonly sold, frankly, is and it's one of the few things that all of these coins have in common, is that if you own a coin, that imparts to you a certain right. And that one right that all of these coins impart, and I do think all of them impart it, is the right to participate on the platform. So if you own a coin and the platform sells a product or service or good or something along those lines, owning that coin imparts to you the right to use that service on that platform. That is probably the singular underlying characteristic of all ICOs that exist. After that, it's a hodgepodge. And so let's think about, investors can think about the cryptocurrency market in a lot of different ways. You can break it apart in a lot of different ways. But I want to break it apart in a really simple way and say that there are basically 3 types of coins that are out there. Okay, the first type of coin we talked a little bit earlier, and those tend to be more like platform and protocol coins. And so those would be your Bitcoins and your Litecoins and your Ethereums and your Zcash and and Stella and coins along those lines. And as a general rule, those coins tend to be some of the largest coins in terms of market cap in the marketplace on an individual and also collective basis, right? Very, very few utility coins that are bigger than the major protocols. Then you'd have this enormous, and I do mean enormous, subset known as utility coins. And, I haven't done an actual statistical study on this, but I'm just going to give you my interpretation. If you looked at it purely not from a market cap perspective, but like the number of publicly traded coins, I would venture to say that, 90% of the coins out there, maybe even greater, fall right now into the category of utility. And utility coins, as we spoke of earlier, really impart on you one very singular right as an owner, which is to use that coin to participate in one way or another on that project's platform. Now, that might be your ability to pay for things. That might simply be your way to actually even just enter the platform. You might have, voting rights. But, let's make something up. Let's say that you're a charity and you've issued coins to raise money as a charity. Perhaps if you own those coins and each one of those coins represents a vote, you as a community might vote on the charitable projects that you want to see money going to, right?
Yeah.
And those constitutes a very, very large lion's share of the market. Again, like not a statistical study, so I don't want to be held to it, but I would venture to say on a pure numbers basis, they're probably 90% of the coins that are out there. Now, those business models, for lack of a better way of putting it, are often untested. The economics and how those tokens work inside of those projects are mostly untested. And the reason why I say that is that the bulk of projects that are out there today are still kind of in development. They are, and there's nothing wrong with that. I don't want people to go, oh, well, he thinks there's something wrong with like the fact that these guys are working really hard to do what they said. Not at all. That's not at all what I'm saying. What I'm saying is that from a user perspective, a lot of these projects aren't up and running. And you're not going to really know until they are up and running two really important things. One is, does it work and does anybody want to use it? And B, if you use the token on it, does it really work, right? Like not that the token really work, but does the business model really allow for it, right? So what does that mean? Like if I was a listener, I'd be like, that's really interesting, but what is he really saying?
Yep.
So let me give you an example of what I'm talking about, if that's okay. Is that okay?
Sure. Yeah, of course.
Okay. So let's say you have a project and everybody loves the project. It is incredibly exciting. It's a huge market that they're going after. There's real problems in the market that they think they can solve. Phenomenal team, wonderful. And you own the coin. And they say to you that when we get this project up and running, you're going to have to use the coin to pay for whatever this particular service is that we're imagining right now. Okay? Let's imagine that you're going to rent storage space. I often think about like this, storage space. Everybody loves the coin. So here's the conundrum. First, you have to buy the coin. So you have to go through the process of buying the coin, which in and of itself, for a lot of people, is not always particularly easy, like especially if you're first new to cryptocurrency. You have to move your money from a bank into a crypto exchange. You have to go on a crypto exchange. You have to buy that particular coin. You have to store the coin. You have to have enough of the coin to use on the project. And because of that volatility we spoke of earlier, you want to have a little bit of a cushion because like you just don't know, right? You don't know, right? And then you have to transfer that coin onto the project in order to use it. And also, if you're in the United States and you do that, okay, along the way, you, believe it or not, are actually triggering taxable events. So not only are you spending money on the project using your coin, but if you bought the coin at $1 and you sold the coin at $2 to buy the product, you've now created a taxable event. So there's tax on that. Now, there is some legislation in Congress for allowing transactions underneath a value, I believe, of $600 not to be taxed, but that hasn't gone through yet. So right now, as things stand in the United States and in other countries, using coins actually costs you money on top of what you're buying. So that's a little bit of a problem, but they'll work that out. The other problem is something far, far more fundamental. Let's say you have two guys. Let's just say you have one guy. Let's make it simple. They love the coin. They can't get enough of it. They own it because they think this is the greatest project on the history of the coin, and the coin keeps on going up in value. Now, think about the psychology of investors. The coin's going up in value. This coin is very valuable to you as an owner. If too many people hoard those coins, right, as speculators, as investors, okay, and therefore choose not to use that coin, there's an unwillingness to essentially give up those tokens because of the speculative value that they think they're going to make on them. How do you pay for things on this platform? Now, some platforms will let you pay for things using cash and other payment vehicles. So, if it's a product or service that's like kind of like they happen to be a blockchain company, but they happen to be a business also. But a lot of these are based on creating utility on the notion that this coin is going to be the sole payment vehicle in there. Now, some of them have been smart enough to set up reserves in order to facilitate this, but not everybody has. So just take it to the next logical conclusion. If everybody holds onto their coin because of the speculative nature of it, because they don't want to give up that next move up because the project's just so amazing, but nobody's actually using that coin to actually buy anything on the project, there's a tipping point at some point where people realize that you can't buy anything on the project because nobody's giving up their coins. The coins lose their value because there's no utility function in them.
Right.
And so when I say that some of these things have not really yet proven themselves out, it's not because I'm a doubter. It's not because I'm a negative or a naysayer. It's not that I don't believe that there aren't a number of these that are really well thought out and well designed. It's just that it hasn't been proved out yet.
So Barry, if you're going through the initial public offering process, if you're an equity, you have to file a prospectus with the SEC, and they look at it and they go back and forth with comments. And they can validate that the business will be a success, but they can validate that, or try to validate, the SEC can, that what's in there is a fair representation of what the business represents. And
that's correct.
And that the financial statements are in accordance with GAAP because they were audited by an auditor. And again, they can't prove those are accurate, but there's a process in place. If you are an ICO that comes out, could be a 10, 15, 20-page white paper written by a bunch of folks who have an idea. What process does that go through for potential investors to say at least there's some legitimacy to this enterprise?
Well, the market is evolving. I mean, that's the true answer. Like, the market's evolving. So, like, what you could do a year and a half ago versus what you could do today aren't necessarily the same thing. And law firms, especially the good ones, they are very, very sensitive to the legitimacy factors around an offering. Now, I'm not telling you that there aren't coins that are coming out there that haven't been necessarily vetted. That's the last thing I'm going to say. But good projects are leaning towards using lawyers that really are quite strident about going through the makeup of the business model, how they are legally structured, the team. Have you thought through directionally where you want to take the business? Is that reasonable? Have you thought about your budgets at all? Now, not everything has to be nailed down to the penny. That's not what it is. But just kind of like, have you even thought? I mean, I've been on a couple of due diligence calls on a few of these things, and they haven't even thought through their revenue model yet. Here's the problem. We're going to solve it. Okay, well, that's great. Well, do you plan on making money? Well, we're not sure how we're going to do that yet. Oh, okay. Well, maybe you might want to think about that.
When somebody buys into an ICO, they buy an ICO, and it's for, I don't know, catnip. I'm making it up, whatever it is.
Yep.
Are they buying the ICO for the speculative nature that you start to get momentum in the awareness of this company and the purpose that they serve, and that the coin is going to increase in value based upon this speculation? Or are investors buying the coin because
They believe the underlying business fundamentals. And this is where I, as an equity and debt analyst, try to understand. Is it based upon the fundamentals that are going to start to become generated? And whether or not they generate cash or not, I understand early stage venture, it's about growth and getting that growth. What mechanism is in place for these ICOs to communicate their economic progress? Is it quarterly? Is it half year? Who's mandating that? And so why is somebody buying into this? Because the underlying business, or because they think it's going to be a good story and there's going to be a lot of speculative nature that's going to cause a feeding frenzy?
Yeah, I mean, honestly, I think the answer to that question is yes to all the above. Different buyers will feel differently. The same buyer who believes in the project also might be reasonably excited by the fact that this might be a hot deal, right? I mean, you can't,
Right.
Unless you're an aesthetic, it's really hard to divorce yourself from the concept of monetary gain, right? So even if you're a diehard believer in the project, I mean, my guess is that you'll be happy that the $500 that you put in to buy this on day one is now worth $1,000. Of course, I'm making that up, right? I mean, I'm not at all suggesting those kinds of rates of return or even bigger ones. I'm just using it as a point. Very few people I know, and I'd like to meet them, would actually be annoyed at the idea that they put $500 into something and it's now worth $1,000. Like I just, I'd like to know that person. And so I think it's both. But to be fair, there's a lot on the extreme side, right, where people are constantly talking about like how this coin is going to be, a 100 bagger, a 10 bagger, or whatever bagger it is, right? And which is fine. There's nothing wrong with, speculating on your speculation. But there is a lot of that in the marketplace, and how and where that speculation comes from is also really sometimes questionable, right? Like, so if you have an individual and this is what they believe, and here's the 3 reasons why they believe it, that's fine. But you have a lot of people out there whose self-interests aren't necessarily always aligned with the general investing public, and who may in fact actually even be paid to propagate information in order to jam the price of the coin higher after it gets into the public market. And I'm not talking about being paid by the project. There are, from what I've heard, I've never met any of these people, but I've heard about investors paying other people to do that in order to, facilitate, a speculative frenzy. So there's all manner of stuff. Now, again, and this is when the SEC starts to say, so we have to step in because our primary mandate is investor protection. I mean, first and foremost, that's what it is. And because there's a lot of this stuff that takes place in this market, because it's global and it's relatively unregulated, and what regulations exist are a hodgepodge, and even inside the same country, those regulations ebb and flow and often can be even contradictory. It does, and since they are not characterized as a security, while it's illegal to engage in what's known as a pump and dump scheme, no matter what, security laws are very, very different than normal commercial laws. And so the idea of insider trading, the idea of insider sales without acknowledgement, that stuff is basically unregulated. Now, the industry has tried to create some backstops to that. So what you and I would call insiders, which in this industry is known as founders, often will get, some piece of the underlying coinage that's being issued, and that can vary a great deal. I've seen all manner. I've seen close to 0 to as much as 50%, and it depends on the project. It depends on a lot of things. Those coins typically have a vesting schedule, and that vesting schedule is made public, and those coins are held in a smart contract that is, if you're legitimate, is publicly viewable, and therefore outsiders can validate that, insiders haven't sold the 10% of the coins that they're getting like 2 months after it's now, gone on some big exchange and everybody's super excited, right? So they haven't liquidated. There is some self-policing, but you got to remember that doesn't mean that everybody does it. It's a good thing if you do it. It's kind of becoming more and more the standard, if you will.
Mm-hmm.
But it's not an enforced standard. It's more of a social enforced standard, right? Like it's like when you go to a party, it's not a really good idea to start making fun of the hostess's taste in furniture. Like you just
Right.
like as a social standard, that's considered to be not a good thing. There's no law that precludes you from doing that, but people just don't.
Yep.
And so, there's a lot of what this industry is about is really in some ways predicated on kind of like a moral suasion. If you were an economist, you would use that word, moral suasion.
Yep.
You would, in this particular case, you would probably call it like, social suasion.
Okay, so now we've talked about utility tokens. We've talked about the features, benefits,
protocol, and so the last one is I think going to be ultimately the biggest.
And this is what
utilities are
Mark,
going to be big,
yeah,
but it's going to be secure. It's going to be security tokens.
Yeah, Mark seemed to be very excited about those too. Can we dive into those?
Yeah. So that would be the third out of the three of kind of breaking down this market. And security tokens are relatively nascent. Again, I've used that word a couple of times in this. So as a sheer number that are currently outstanding, they're relatively small. Or arguably probably not much bigger on a percentage basis than like a lot of the protocol coins. Maybe a little bit, but not a ton. And security tokens, the simplest way to think about security tokens is that at the end of the day, they're really like an investment contract. Like in one way or another, these are registered tokens versus unregistered. And they will impart to you things that often will look or feel like traditional equity or debt. Now, there are twists and turns, so it's not exactly like a stock, and it's not exactly like a piece of debt, but they are attempting to impart to you through what could be described as an investment contract, some form of ownership that comes with some additional rights. Now, those rights may be the rights to the long-term capital appreciation of whatever those security tokens represent. Let's say real estate or dividends potentially. Again, not necessarily having to be paid, but if they were, and people said that they were going to pay dividends, when they are paid, if you own the coin, you are entitled to it. Some people are trying to figure out how to tokenize debt itself. There's been some small private attempts at that. There's been a couple of transactions that have taken place, but they haven't been public transactions. So like these are kind of like behind the scenes, closed doors kind of things. But I don't even know if we're in the first inning, Mike, of this. Like I think everybody's stretching on the field right now.
Mm-hmm.
And all the spectators are getting beers and hot dogs and their kids cotton candy. I mean, that's how early in the game we are. But I think it's going to be massive. I think it's just going to be massive.
So walk me through what are they and why?
You can design a lot of things around a token that you might not be able to design around like a traditional investment. Like you can create business model designs or security value designs that are different. So I think that those are really interesting. And that's a long subject matter, but I'm just going to throw it out there. The cost to come to market is lower. So there's a lot of frictional cost that comes out of the system, which is great, right? Because that frictional cost, you got to remember that frictional cost in one way or another is a burden that both the company and therefore the people who may own some element of the capital structure within that company bear, right? Like every dollar that you spend on Goldman Sachs or Morgan Stanley, I'm not picking on them, any investment bank to underwrite you, whether it's debt or equity. Those are dollars by definition that are not going into the company, right?
Yeah.
You know, and I don't care if it's like 1% or it's 7%. That's money that's not going into your hand.
Yeah.
And so, and some people might say, well, I mean, really, Barry, Like, I mean, if somebody's doing a security token for a company and they want to raise 40 million, like, are you telling me that that $3 million is the difference? And like, I'm not trying to say that. I mean, to that company, it's a lot of money, right? To that company, it's a lot of money. But you're right, $3 million in the scheme of the size of the universe is not a lot of money. Now take that offering and start multiplying it by all the offerings that are done. Right? You know, it's very easy to kind of get caught up in the minutia of, oh, well, it's not a lot of money on this deal, it's not a lot of money on this deal. I mean, you could say the same thing about Wall Street in general. It's not a lot of money on that deal, it's not a lot of, the next thing you know, it's a lot of money. Right?
Yeah.
So there's a lot of friction cost that can be taken out of the system. On top of that, there's time, right? So to go from a private company to a publicly traded company, as a general rule, is longer than what it's going to take you to do an offering, a security token offering in the cryptocurrency space. So there's time to market, which is great, right? I mean, people who have never been through the process, you've been through the process, I've been through the process, can't really imagine what that's like on a day-to-day basis. Like all the time, instead of doing what you should be doing or want to be doing or need to be doing because of like what you do, you've tremendous amount of hours that go into just walking down the aisle to get a deal done. I mean, it's a lot of work anyway doing an ICO, don't get me wrong, but it's nowhere near what we're talking about here. Okay? So there's that. And people who've never done it might just kind of brush that aside, but it matters. Okay?
Yeah.
There's also the immutability of your ownership. Like nobody can really take it away from you because it's on the blockchain. Like, you know, and again, places like America, or if you're sitting in London or someplace like that, maybe like that's not something you think about, but there's a lot of places in this world where confiscation of assets is no small matter, right? And there's a lot of money out there that is looking for ways of ensuring that they have liquid asset, liquidity with high value assets behind it that could over time both appreciate and pay cash flow. I mean, there's a lot of people out there. And I'm not talking about some banana republic. There are some very notable and very large countries in the world with an awful lot of wealth where people that's very important to them. And so that's also a real big positive. Plus these things are traded, so therefore you could see them. I mean, it's, you know, if anybody's ever owned a bond, you know, when they get their monthly statement from Schwab or whatever it is that the brokerage account is, I mean, yeah, they put a price on it, but I mean, they don't really trade. Like, you know, if you own corporate bonds, they don't really trade. There's a price, but they don't really trade. These things trade. And so you can actually own something that more or less looks like a bond or a cash flowing instrument that actually will trade more like a stock than it does a bond. That liquidity preference, or that potential for liquidity preference, that's enormous. Go talk to a fixed income guy and ask him how easy it is to sell $50 million of a corporate bond issuance, and you'll understand what I'm talking about. It ain't that easy.
Is real estate one of these things?
Real estate is top of mind on one of these things. I mean, you have huge embedded value. You have functionally a lot of friction costs that are embedded in the real estate system itself, between issuance and capital raise to simply brokerage and legal. So there's enormous amount of capacity there. A lot of real estate isn't available for the public to own. It's either not traded in a vehicle that will let them own it, or they don't really have easy access to it. I mean, like, you know, New York City is a great example of this. You know, I mean, if you're worth $500 million, you can buy, you know, a $20 million apartment in the Time Warner building if you're inclined to do so. But there's a lot of reasonably well-off people who are looking to diversify, to have liquidity, to have access to really what is quintessentially one of the world's best and biggest and most deepest global real estate markets. And it's not easy. If you live in Singapore or Korea or China, or for that matter, Switzerland or the UK, it's really hard to buy property in other places. This will become a global phenomenon. Like, you will be able to own pieces of property in countries that you've maybe never visited or can't visit or can't buy. So it's going to be tremendous. It's just going to be astronomically large. And the real estate market, like so many other markets, is stodgy. It's stodgy. They're not even on top of this. You and I both know this from some conversations we've had about other things. I'm willing to bet there's a lot of people in the real estate market who have no idea that any of this is happening. And they're not even going to know how to react when it does start to happen. They're going to be like, what does this all mean? And there's an enormous value to first movers who really understand how powerful this is. And I think personally, I think it's going to be just a astronomically large, and I think it's going to be a global phenomenon.
Interesting. All right, listen, we are out of time. This has been really, really. No, I mean it's been very fascinating for me to learn about speculation versus investing in business concepts and the utility tokens and the security tokens, and it was great. I appreciate it. So tell me, what you just launched with Frank, right?
Yes, I did. That's
okay,
right.
so
Crypto Intelligence.
Crypto Intelligence, and what is that all about?
Well, it's a monthly newsletter that's going to dive into the cryptocurrency market, and some of it will be educational. And we've already put out a bunch of videos that are available to people. We're in the process of putting out what they call a book or a primer. In the investment industry, you would call it a primer. And then monthly, you're going to get a newsletter that talks about what's going on in the market, maybe, or an issue that you need to be aware of, or something that might not be great, but also ideas that we think are attractive. And for whatever those reasons are, each idea will have its own merits. And we'll be delivering that to subscribers. And that's, in a nutshell, really the whole genesis behind the newsletter.
Great. All right,
and hopefully
Brother
along
Cohen.
the way we help people and they make money.
Great. All right, man. Thanks, buddy.
Right. Thank you, Mike. Really appreciate it. And thanks everybody for listening.
Well, I just took you along a little journey with me and Barry Cohen. And like I said earlier, I have not ignored, but I've just been focused on other things, and I haven't spent too much time for this asset class that some really smart people I know, whether Mark Yusko, Barry Cohen, are really very excited about. So I decided I wanted to get a little bit up to speed. Now, in honesty, when I'm not going to get too up to speed for myself, because when I have a question, I'm going to call them. But not everyone's going to have access to them. So, but I'm going to start to get smarter on it. And just, I think, anything that's this popular, I hate being ignorant, and I was starting to feel ignorant. And so hopefully this enlightened you a little bit, and I hope you found some value in it. And I will be back next week. And next week we are going to be talking uranium. Thanks. Have a good week, and I appreciate you listening. Take care.
The information presented on Talking Stocks Over a Beer is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.